Before money as we know it existed, how did people get what they needed? Imagine wanting a new clay pot, but all you have are some extra bushels of wheat you grew. You'd have to find someone who not only had a pot to spare but also happened to need wheat at that exact moment. This early form of commerce was called the barter system. It was a direct trade of goods and services, a simple concept that worked for small, close-knit communities. If your neighbor had an abundance of apples and you had milk, you could make a fair swap. This system, however, had a major flaw: the double coincidence of wants. Both parties had to desire what the other had, which often made trade difficult and inefficient. What if the potter didn't need wheat but wanted a woven blanket instead? You'd have to find a weaver who wanted wheat, trade for a blanket, and then go back to the potter. It could get complicated very quickly. This inefficiency slowed down economic growth and limited the scale of transactions. People needed a more reliable and universal medium of exchange. So, societies started using commodity money. These were items that had intrinsic value on their own, even if you weren't using them as currency. Depending on the culture and location, all sorts of things were used. In some parts of Africa, cowrie shells were a popular form of currency, while in ancient China, they used small tools and spades. Even things like salt, which was valuable for preserving food, were used. In fact, the word salary comes from the Latin word sal, for salt, because Roman soldiers were sometimes paid in it. These commodities were more convenient than bartering, but they still had problems. They could be perishable, difficult to divide, and a real hassle to carry around in large quantities. Imagine trying to buy a house with thousands of shells or a cart full of salt. There had to be a better way, something more durable, portable, and easily divisible. This led humanity to one of the most significant financial innovations in history: metal. Specifically, precious metals like gold and silver. These metals were rare, they didn't rust or decay, and they were beautiful, which made them highly desirable across different cultures. Initially, people traded chunks and nuggets of gold and silver, weighing them out for each transaction. This was an improvement, but it was still cumbersome and required scales to ensure a fair trade. Around 600 BC, a kingdom in modern-day Turkey called Lydia came up with a brilliant solution. They started minting the world's first coins. These coins were made from a natural alloy of gold and silver called electrum. Each coin was stamped with an emblem, often a lion's head, which guaranteed its weight and purity. This was a revolutionary idea. Now, instead of weighing metal for every purchase, you could simply count out the coins. Trade became faster, easier, and more trustworthy. The concept of coinage quickly spread across the ancient world. The Greeks, Romans, Persians, and Chinese all developed their own sophisticated coin systems. Money was no longer just a tool for trade, it became a symbol of power and a way for rulers to spread their image and influence across their empires. For centuries, gold and silver coins were the backbone of the global economy. They facilitated everything from small market purchases to the grand expeditions of explorers. However, carrying around bags of heavy metal coins still had its drawbacks. As economies grew and trade routes expanded, merchants needed a lighter, more convenient form of payment. The solution came from China, once again leading the way in monetary innovation. During the Tang dynasty in the 7th century, merchants started leaving their heavy coins with a trusted agent. In return, they received a paper receipt detailing how much they had deposited. These receipts were much easier to carry and could be exchanged for goods, essentially becoming an early form of paper money. By the 11th century, during the Song dynasty, the government took over this system. They began issuing the world's first official, government-produced paper money, known as jiaozi. This was a pivotal moment. The value of this money wasn't in the paper itself, but in the government's promise that it could be redeemed for something of value, like gold or silver. This is known as representative money. The idea of paper money eventually traveled west, brought back by explorers like Marco Polo who were astounded by the concept. However, Europe was slow to adopt it. It wasn't until the 17th century that the first European banknotes were issued in Sweden. People were skeptical at first, preferring the tangible value of their gold and silver coins. But the convenience was undeniable. Banks began to issue their own notes, which were promises to pay the bearer a certain amount of coin on demand. This made large transactions significantly simpler. Over time, governments took sole control over issuing currency, creating national central banks to manage the supply and ensure stability. This worked well for a while, with most currencies backed by a gold standard. This meant that every paper note in circulation was directly backed by a certain amount of gold held in a vault. This system provided a sense of security and stability to the global financial system. It tethered the value of money to a physical, finite resource. However, the gold standard also had its limitations. It restricted a government's ability to manage its economy, especially during times of crisis like wars or recessions. A country couldn't just print more money to stimulate growth, it had to have the gold to back it up. This inflexibility became a major problem during the Great Depression in the 1930s. One by one, countries began to abandon the gold standard to give their economies more flexibility. The final nail in the coffin came in 1971. The United States officially severed the link between the US dollar and gold. Since then, almost all world currencies have become what is known as fiat money. The word fiat is Latin for "let it be done." Fiat money has value simply because the government declares that it does, and because we, the people, have faith in that government and accept it as payment. The dollar bill in your wallet has no intrinsic value, it's just a piece of paper and ink. Its value comes from our collective trust in the system. This shift to a full fiat system gave governments and central banks immense power to influence their economies by controlling the money supply, setting interest rates, and responding to financial crises. The 20th century also saw the rise of electronic money. Credit cards, introduced in the 1950s, were just the beginning. They allowed for cashless transactions, where money was just a digital entry moving from one bank's ledger to another. The invention of the internet and computers accelerated this trend at an incredible pace. Online banking, wire transfers, and digital payment apps have made physical cash less and less necessary for many people. Today, the vast majority of money in the world exists only as digital records on computer servers. It's a far cry from a farmer trading wheat for a pot. And now, we are on the cusp of the next great evolution in the history of money. The digital age has given birth to a completely new concept, cryptocurrency. In 2009, an anonymous person or group known as Satoshi Nakamoto released Bitcoin. It was the world's first decentralized digital currency. Unlike fiat money, there is no central bank or government controlling it. It operates on a technology called blockchain, which is a distributed public ledger maintained by a network of computers around the world. This means transactions can happen directly between two people, anywhere in the world, without needing a bank or financial institution as a middleman. The idea of a currency free from government control and traditional banks is a powerful one. It offers the potential for lower transaction fees, greater privacy, and financial access for people who are unbanked. Bitcoin paved the way for thousands of other cryptocurrencies, each with different features and goals. Some are focused on speed, others on privacy, and some are trying to create stable digital currencies pegged to real-world assets. We are still in the very early days of this new financial frontier. The future of money is being written right now, and it's likely to be a mix of traditional and digital systems. Will cryptocurrencies replace fiat money entirely? Or will they coexist, offering different options for different needs? Central banks around the world are also exploring the idea of creating their own digital currencies, which could blend the efficiency of crypto with the stability of government-backed money. The story of money is a story of human ingenuity. It's a constant search for better, more efficient ways to store value and exchange it with one another. From a simple barter trade to a complex global network of digital transactions, money has transformed our world, enabling the growth of civilizations, trade, and technology. What the next chapter will look like is uncertain, but it's guaranteed to be fascinating. If you found this journey through the history of money interesting, be sure to subscribe to Financial Cake for more insights into the world of finance.